Okay, I think the sound is good now. Hi everyone, and welcome to the Octa live trading session. My name is Ambrose Ebuka, and in this session, we're going to have amazing discussions, Forex related discussion as well. But before I go into the details of what we're going to be discussing, you can let me know in the chat your name and where you're watching me from right now. So let me know in the chat your name and where you're watching me from. You can also let me know if this is your first time, trading, or your first time taking part in an Octa live trading session or an Octa webinar. Let me know in the chat. We're 8 trading days into February, and yeah, I know that this includes the weekends, and I say 8 trading days because with Octa you can trade cryptocurrencies. If you have an Octa trading account, you should be enjoying and capitalizing on this features already. And if you don't, you can always create an Octa trading account with a link in the description, maybe after this session, so that you don't miss out on the discussion we're going to have today. So let me know your name and where you're watching me from in the chat. So what are we going to learn today? We're going to look at some of the ways that you can analyze the market, and I'll show you the way that I analyze the market, starting with the news before opening trades. We're going to do all that, and I'll show you the methods of opening trades and closing trades in real time, the things you should look out for, some of the important confirmations you should have, and that includes the steps to trade the market. And if you have any questions, I'm going to answer them. All you have to do is ask your questions in the chat. If you also have, some pairs that you want me to analyze, you can let me know in the chat as well. I'll look at those pairs and, try to figure out areas where we can take trades. All right. I'm just going to look at the comments now to see who we have in the chat today. Hazan from Kaduna. Nicholas says, good evening. Welcome, everybody. I see a lot of people joining as well. Welcome. If you're just joining, this is the live trading session with Octa, and this video is going to be saved in the YouTube channel, so you can always come back to watch, so you don't miss out on anything. All right, we're going to start with looking at the news first, because again, a country's economy is going to have a reflection on the domestic currency of that country, right? So if the economy of, let's say, the United States is good, then it's going to have a positive value or a positive impact on, the US dollar, right? The same thing goes for Japan, goes for London, even goes for Nigeria as well. And yeah, so we're going to look at the events that we've had today. My filters are set to high impact events, but because, we have some, diverse traders, all level traders in the chat, I'm going to add medium impact and low impact events as well, so that we just, take a look at everything. Now, and this is an amazing feature, being created by Octa. If you're a beginner trader, I would say it's important that you include the low impact events as well. Yes, they may not really have, any impact to the currency that you want to trade or to the markets, but it's important that you get the knowledge, right, to know what that event is all about. The same thing goes for medium. Now, when you're conversant with these reports and you know what they mean, then you'd be able to filter the ones that you want to pay attention to, right? So I focus on medium and high. Sometimes I just look at only high impact events, but as a beginner, you want to look at both medium, low, and high. You get the knowledge and you build that trading confidence. Someone is saying something about voice. Let me know in the chat if you guys can hear me clearly. I think I fixed that. Let me know in the chat if you guys can hear me. John Awele from Lagos, welcome. Iberi from Akwa Ibom State, welcome. James Linus from Abuja says it's his first time. Welcome to the live trading session with Octa. Usually these live trading sections contain, insightful information that can help you improve your trading knowledge and increase your trading abilities, which would potentially increase your profitabilities in the market. All right. Okay, you guys can hear me clearly. So with the economic calendar, this is the Octa economic calendar, and I got here by going to the website, the Octa website, octafx.com, and you come down to analysis and education, and under analysis and education, you want to come down to analytics, right? And here you'd see the economic calendar, so you just click on that, and it opens, right? And then you have access to the economic calendar. The economic calendar shows you what's going on economically in different countries, right? You have and how it impacts the currencies of that country, right? So you have CNY, which is the Chinese yuan, which obviously this report is going to be coming from China. We have JPY, which obviously this report is going to be coming from Japan. Now, Euro sometimes doesn't come from just one particular country, but if you click, you can always click to know which, country in Europe it's referring to. Okay, but generally, the reports would impact the euro. We have America, which is obviously going to impact the US dollar. Again, and sometimes most of the speeches would come from the European Central Bank, would impact the euro as well. And if you look at the reports we have today, we have quite a number of speeches from members of the executive board of the European Central Bank today. Now, some of the important events we had today were the PPI, Chinese PPI, the producer price index, consumer price index. And I think the speech by Governor Bullock from the Reserve Bank of Australia today, this is happening at 10:30, right? So another thing to keep in mind would be the timing, because by default, this may not be at your specific time zone. So you also want to change this to your specific time zone so that you don't miss out on the reports for that day. Okay, I'm seeing your questions. And again, guys, if you have questions, you can always ask in the chat and I'll answer your questions as we, at the end of the session, there's going to be a Q&A section for me to answer your questions. Now, if you don't know what producer price index means, the producer price index is an economic indicator that is used to measure the average change in prices received by domestic producers for their output over time. Now, in simpler terms, or should I say layman terms, the PPI tracks the average change in prices received by producers for their goods and services at various stages of production. Now, there's a system to it. There's a way it works, right? There's a, should I say step? Yeah. So the first step would be to select the commodities, right? So there's something called the Bureau of Labor Statistics. It's the BLS. So if you come across this in, articles by economists or investors or analysts and you see BLS, you just know that they're referring to the Bureau of Labor Statistics. Now, the BLS selects a sample of goods and services that are produced domestically. And these goods and services can represent various industries or various sectors of the economy. When they select this sample of goods and services, then they collect the prices, right? There's something called price collection. So the prices for these selected goods and services are collected from producers, manufacturers, and wholesalers. Now, the BLS would gather the price through surveys, through interviews, a lot of other methods. They gather this data and then they do what we call weighting, right? So they calculate the weight. They identify the weight based on its importance in the economy. Now, what the weight does is it's going to reflect a contribution of the commodity to the overall production in value. Now, once the weight has been identified, then they do what we call index calculation. So the index has been calculated, they compile the index, and the result has been released, right? So they release the PPI data and it's released monthly by the BLS. And this is a report that is, watched or observed by economists, policymakers, businesses, investors. It basically serves as an indicator of inflation pressures in the economy. And what we can now do is to analyze the reports that we have and see how it impacts that currency. So if you're looking at, let's say, this report right now, you can see that the previous report was at minus 2.7. The forecast was at minus 2.5, which is just a bit lower than 2.7. And we got an actual report which was even lower than minus 2.7. So you see here that generally speaking, a high reading is seen as positive or bullish for the Chinese yuan, whereas a low reading is seen as negative or bearish for the Chinese yuan. Now, most times, when a report is being released, it doesn't really have an immediate impact on the markets. Usually during NFP or CPI or these high impact events, right? The impact may come at 30 minutes later, 1 hour later, sometimes a day later. Okay, so you don't just want to take your understanding of the economy here and go straight to the chart and start buying immediately. You want to combine your fundamental analysis with technical analysis, which I'm going to do today so we can see what the market is telling us and look for areas where we would enter trades, right? So that's it on PPI. I think another important event here would be the CPI. So I'll just briefly explain, CPI, and we can now go on to the charts. So CPI, which is also known as the Consumer Price Index, is a measure of the average change over time in the prices paid by consumers for goods and services. And the CPI is one of the mostly used indicators for tracking in the inflation. And if you don't know what inflation is the rate at which level of prices or the general level of prices for goods and services is rising. The steps for or the steps to the release of CPI is just almost the same with the one for PPI. They select the goods and services, collect the prices from retail stores, rental units, establishments, just across specific geographic areas. Now, PPI is producer, just to differentiate the two. It's a producer price index. CPI is consumer price index. If you remember PPI, the price collection is being done from producers, right? Now we're looking at consumer price index and we're getting the price collection from rental stores, rental units, from different areas and different industries like food, housing, clothing, transportation, medical, recreation, education, all that. So it's different. And again, the CPI is mostly used to track inflation. Okay, so let me know in the chat if you guys understand the difference and understand CPI or PPI. And aside that, we also have the speech from the Reserve Bank of Australia coming up today at 10:30. And this is going to impact the Australian dollar. And one of the reasons why you should pay attention to, the speeches by the governor of the central banks of different countries is because, they make some really important statements that relates to their stance on monetary policy, right? Are they increasing the exchange rates? Are they reducing it? What are they actually, what's their plan? When you understand their plan, then you can understand what they want to do, the actions they want to take, to either curb inflation or just make sure that, the economy is good. You would know the plans that they're going to take. Now, that plan, which is obviously going to be an action, it's going to impact the domestic currency of that country. Okay, Hassan says he understands. So we have important reports coming tomorrow. I think we have one from Canadian dollar. We have monetary policy from the Fed. Tomorrow we have unemployment rate, which is going to be a high impact event for the Canadian dollar. So we're going to see, I expect to see some volatility on the Canadian dollar tomorrow, and also monetary policy reports coming up tomorrow as well by 4 p.m. So these are some of the things I would keep an eye out on. We'll just observe, these reports and see exactly how they impact the markets. But we're going to go over we're going to go to the charts right now, and I'll show you guys my analysis and what I think or my bias for different currencies. Now, if you have any instrument or asset you want me to analyze, you can let me know in the chat. So we're going to start with the dollar index first. I'll walk you guys through my, analysis, the process of my analysis. And it's also something that I believe you guys can, adopt and refine or implement in your own strategy. All right, I'm going to start with the dollar index. And the reason I like to start with the dollar index is because I trade, major currencies, pound dollar, euro dollar, gold, dollar loonie. These are currencies that are impacted by the dollar, right? We're seeing the dollar being paired to these currencies. So whatever happens to the dollar is going to have an influence on these currencies. Okay, so that's why I look at the dollar index first. And what are the steps, right? I'm going to go over a framework that I use. We're going to use the framework in this analysis as well, so you guys can understand properly. And I think I'll just go ahead and type out the framework. Let's see if I have it saved somewhere. Okay, not really. Guess I'm just going to go ahead and type the framework then. So the first thing that I'm going to do, and the framework, by framework, I'm talking about like the step. What do I do if I come to the chart? And I get asked that question a lot. How do I find areas where I can buy or sell? How do I understand what the market is telling me? Now, for beginner traders, well, regardless of your level of trading experience, right? Until you get to the point where you have an approach to the market, you know what the market is telling you, you can identify areas of, support and resistance, supply and demand trends. You may never really understand what the market is telling you, right? You're not going to just understand the direction of the markets by guessworking or taking a first glance and you're saying, well, I'm going to buy here. One of the fastest things you can get from taking a first glance at the market is just the trend, right? And when you start to look closely, you start to spot some supply and demand zones. And if you go deeper, you spot some really important key levels. Okay, so there should be an important step that you want to take. And the first one would be what we just did right now, which is check the news, right? Again, I always tell you guys that economic events have impacts on the markets, right? And the economic stability or instability of a country is also going to have an impact on the domestic currency of that country, right? So that's the first thing you want to do. You want to look at the news and understand, is this country actually, is the economy of this country doing great, or is it contracting, right? Is the currency going to reduce in value? Is it going to increase in value? Are the Feds trying to increase the rates? What's the central bank of this country saying? That's what you want to look out for. Another reason to check the news would be a situation where you come into the market and, because you didn't check the news, you see a profitable position just reverse and go in the opposite direction just because you didn't check the news, right? And when you check, you start to see that, oh, there was an event, there was a speech, there was something that happened economically that caused the price to reverse. And this would have been avoided if you checked the news. So you can see that there's a benefit to understanding what's going on economically in a country. That's the first thing. The second thing you want to do is to understand market structure, right? Very important that you take note of these steps because I'm going to be using it as we analyze. So the understanding of market structure includes identifying patterns. By using the candlestick chart, you want to identify some really important and obvious patterns. And in the markets, we have intercontinuation patterns or reversal patterns, right? Aside when the market is consolidating or just ranging, the market can only move continuously in its original direction. Rather, I was going to say initial direction. The market can continuously move in its initial direction, or it can reverse, right? The market can only trend continuously or can start to reverse. So you want to understand what the market is doing. Are we trying to see a trend, a continuous trend, or are we trying to see a reversal? Or is the market just ranging? The understanding of market structure also includes identifying areas of supply and demand, which I like to do on the higher time frames before I go down to the lower time frames, because the higher time frames gives me, an overall view of the market, what is going on a larger or a bigger scale. If I'm able to see where the market is going to move on the higher time frames, like say I'm able to see a potential 1,000 pips, 2,000 pips move, I can go to the lower time frames and trade in that direction and potentially get up to 200, 500 pips of that 2,000 pips move that I saw. So the higher time frames gives me a kind of confidence in the direction of the market more than the lower time frames, because the lower time frames have a lot of noise. Like imagine trading, you want to trade a trend, or you want to identify the trend of the market, and you're going to the 5 minutes time frame or the 1 minute time frame. You're not going to find any trend there. You're just going to find a lot of noise. Okay, so important, higher time frames. Now, the third thing you want to do, or the third step, would be to identify key levels. Now, these key levels would be done with the use of some tools. This is where the tools come in, the trend lines, the Fibonacci, the moving average, your horizontal lines for support and resistance. The tools that you can see here, all these tools that I'm also going to show you, we're going to really do, going to go deep into the analysis today, so you guys would see everything. So trend lines, you identify them. This is where you're identifying the key levels, the areas where you want to really pay attention to and take trades. That's the key level, right? You want to be looking at the key levels. Guys, don't get me wrong. I didn't say you want to take your trades at the key level. I said you want to look at the key level and observe what the market does at that key level, and that's where you can start to react to the market. Okay, you want to look at the key level, observe and understand, is the market bouncing off at this key level, or is it trying to break below the key level? And then you can start to look for areas where you should enter the trade, which leads us to the fourth step, which would be identifying entries, right? And the way I like to do that is with two things, right? The moving average and candlestick momentum. If I'm looking at a key level right now and I see the market show me momentum, I just look at the moving average and I see, oh, this market is actually bouncing off this moving average, or it is trading above or below, or it's trying to break, then I get my confirmation. So that's the two things that I use: candlestick confirmation, candlestick momentum. Are we seeing an engulfing candlestick? So by candlestick confirmation, I'm talking about candlestick patterns. Am I seeing an evening star at the top of a trend? Am I seeing a morning star at the bottom of a trend? Am I seeing a bullish hammer? Am I seeing a shooting star? I want to be sure what I'm seeing. Is it a doji? Is the market trying to be indecisive right now? Then I know that, okay, if this is occurring at the top of a trend, I should expect potential reversal. So what happens after this pattern? Do I get a reversal? Do I get a continuous move? I want to pay attention to the candlestick, and that's how I identify my entries. And for every trade you choose to enter, you should have an exit point, right? And very important, because most times traders take trades and they get confused on where to exit the trade. So you could take a trade, and this happens especially when they use high lots, right? And you're seeing yourself making a lot of profit, but now you don't know where to exit the trade. Should I close now? The profit you make shouldn't define the closing of your trades. You shouldn't look at how much you're making to say, okay, I'm making $5,000 right now, I'm going to close because I'm making $5,000. Because if it affects your profit, it's also going to affect a losing trade. If the amount that you're making affects your profit, if you're closing because of how much you're making, you're also going to close because of how much you're losing. And at that point, you won't be looking at the market anymore. You're looking at your balance. And that's trading with emotions. And you don't want to do that. So you want to predetermine your entry and your exit point even before taking the trade. So now you know what to look out for. You know this market is going to get to this point. I'm anticipating the market to get to this point. Now, if it's almost getting to that point and I'm seeing a change in direction, I'm seeing a closed reversal candlestick, a closed one, and then I can start bracing up to just put my stop loss into entry or close here. There should be, the market should tell you when to, the market should be the reason you enter and exit a trade, not how much you're making from the trade or closing from the trade. It can be useful, it can help you once or twice, but in the long run, if you keep closing and closing your trades in profit or in loss because of how much you're making, it's going to affect you in the long run. Okay, so you want to identify your exit point, and you can do this with swing highs, swing lows, you know, candlestick closes and candlestick open. For if you're placing a sell trade, I'm going to show you guys how to do this, and use automatic orders like stop loss and take profit. Okay, this is an automatic order where now if you use Octa, you just put in the price where you want Octa to close your trade. Now, even if you're offline or you're out watching a football match, let's say the AFCON, for example, you're watching the finals, and you're not online, you're not active trading at that time, because you have put in that preferred price, Octa is going to close your trade for you at your preferred price. If it's in profit, Octa is going to close your trade in profit, just so that if the market reverses, you don't start to lose the money you already made. And if the trade is in the opposite direction, Octa is going to close the trade at your price that you have already put in to halt that trade from further advance in loss. Okay, so let me know if you guys understand. Sixth step, and the final step would be to apply risk management, and this is where the risk to reward comes in, the lot size comes in. I have no idea where that went. But guys, you can always watch the video to get to, you know, pause and get the sixth step. I have zero idea where it went. Okay, I think I just have to change the text color. Yeah, that almost scared me for a moment. But the sixth step, risk management, that's where your risk to reward comes in, identifying how much you want to risk on the trade and how much you want to profit from the trade. Your lot size, you know, how many lots you want to use, your stop loss level, how many pips you want to risk for your stop loss. If you go through, guys, listen, if you go through these 6 steps before executing your trade, you would have eliminated over trading, high risk, emotion trading, and uncertainty, right? Even though you're not always 100% certain in the market, but in terms of how much you're going to risk on that trade, you'll be certain. How much you're going to make on that trade, you'll be certain about that. Okay? And you need this level of, you need these steps, you need this level of confidence to improve your trading abilities. So now that we're done with the 6 steps, rather, we're going to look at the dollar index. Okay, I'm just going to keep this to the side so you guys can always have that in mind. I'm going to look at the dollar index. And this is on the monthly time frame, so you can see that the dollar index is currently reacting to the significant key level that we mapped out from December 2016 with a retest February 2020, broke out or tried to break out in April 2022, successfully broke out in June 2022, came back to make multiple retests, and it's just currently dancing around this area, as we can see. Now, if you look at the previous monthly candlestick, you can see that this candlestick was bullish. Like throughout January, the dollar was bullish, right? We're seeing recoveries. We're seeing the market recover from this level of demand. You can see here, which is going to serve as our support. You can see how it pushed back up, and February is continuing in the same course. You can see that we're trading above the closing point and above the highs of the previous candlestick, which is January's candlestick. So we're currently trading above there. But one important thing I want you guys to observe in this monthly candlestick is that the market just reacted to these levels from I think we have one from here. I can extend this all the way to the back. 2022, 2023, May, June, August 2023. We can also add this as well because it falls into the zone. So December 2023, and now we're here again at February 2024, and we're seeing the market just react to this level. I'm going to go into the lower time frames and show you guys. Let's go to the 4-hour time frame and show you guys even more information on the dollar index. Now, a lot has been happening with the dollar lately. I mean, you can see that it's moving in a very, I don't know, I should call it slowly but surely manner. And you can see that markets are, potentially boosting the value of the dollar in anticipation of the annual US CPI revisions on Friday. And the dollar has been holding its ground above the 200 period moving average, as you can see. Just let's expand this a bit so you guys can have a clearer view. You can see that it's trading above, and it's holding its ground, trading above the 200 period moving average after, the recent data showed us that there were 218,000 initial job claims last week. So we're just waiting. We're pretty much waiting from waiting for comments from the Fed officials, and we'll see how that's going to impact the dollar. Now, some important things to note about the dollar is that the Fed has not raised its rate since July. The last meeting that was held in January, which makes it the 4th, there was still no change. And this is really not good for the dollar in the long run. Even though we're seeing the Fed tell us that, well, the dollar is we have a good vision for the dollar, we're going to see potential uptrend in the long run. We first have to see that move. We have to see that significant breakthrough some key levels. We have to see the market actually move in a direction before we can join its course, right? The dollar is supported by the world's largest economy, and we're seeing a lot of, budget deficits, a lot of high level of inflation, and this is really not good for the dollar. We're still seeing that America is heavily invested in the conflict in Ukraine. I mean, I just expect this recovery that we have here to be short term, except we have a successful break above this point, and I can start positioning for a long-term run in the dollar. But what I'm seeing the market do is reject at this point. I'm just going to extend this and also extend this as well. So I believe this recovery to be short term. And I expect the dollar to be rejected here and even push back downwards, right? The one factor that has been supporting the value of the US dollar was the anticipation. We all anticipated, that there will be more increase in the interest rate by the Federal Reserve. And if that doesn't happen, then we might start to see a significant historical high point for the US dollar. But again, technicals also play a huge role in analysis. So we trade what we see and not what we think. All right, so we're seeing that the market is currently trading at, or currently reacting to this key level, and this is a key level for us that we have even all the way back to the monthly or the daily time frame rather. I think I'll just switch to the daily time frame and show you guys some of the key levels that we mapped out on there. Let's zoom in. All right, so you see that we can trace this back from June 2023, and we see how the market reacted here again in August, reacted in November, almost made a retest in December but didn't, and now making a retest in February. So we're seeing why this is a stronghold or a strong zone for the dollar. And we're seeing that the market is rejecting. I expect even further downside for the dollar, but if we get a nice break above this point, then across the currencies that are paired with the US dollar, I would be buying the dollar. Okay, but for now we're seeing rejections. I'd go even lower. We're seeing rejections, double top, neckline break, retest, and pullback. I expect this pullback to continue for a while in the dollar. But guys, again, if we get to break above this key level that we have at 105. Sorry about that. If we get to break above this key level we have at 105, then we'll be bracing up for a upward move. 104.5 to 105 psych levels. Then we're bracing up for upward move in the US dollar. So I'm going to go to pound dollar as well. Yes. And again, guys, I always start with the dollar because if the dollar is going up, if the dollar is trending to the upside, then the pound dollar would be going downwards. They are well correlated. Let's give that a second to load up. All right. So this is the 4-hour on the pound dollar. I'm going to go to the monthly time frame. Let's start from there. Try to understand the overall direction. I already have some levels mapped out on the pound dollar, guys. So we're just going to do a revision on that, and I would explain to you guys why these levels are mapped out here and why they are important. All right, so previous in January we closed at a doji candlestick, almost a long leg doji, but we closed at a doji candlestick, even if it's bearish because it closed below the opening point. And you can see that this month, February, has continued to the downside, and obviously it would do that because dollar is going up, right? The February candlestick on the dollar was going up. But one important thing I want you guys to notice with pound dollar, or two things now that I can see, is first, we got to this key level that we mapped out from September, right? If I go to the lower time frames, you guys are going to see a point here where I mapped this out from, because from that point we had a retest here in December, and the market just reacted to this level again this month, February. And guys, this is why it's very important to have your key levels mapped out, to understand the importance of key levels. It's very important. You can see that the market tends to move like a magnet. An area, a key level can be an area where the market could retest in the future. So we have especially on the higher time frames, right? On the higher time frames, very important. So we have the rejection here, and we saw how massive that pullback was, because again, we are reacting to a key level from the higher time frame. This is the monthly time frame. You see how massive the pullback was here. You see how massive the pullback was. Now, again, if you are looking at the monthly time frame for your analysis, right? You're trying to understand what's going on in the market. You're trying to do that from the monthly time frame. Then your targets would be a lot higher than your targets on the lower time frames. Now you could look into the future and see a potential move of 1,000 pips, and then when you go to the lower time frames, you can now trade in that direction, because what you're looking for is the lower time frames to trade in accordance with the higher time frames. If the higher time frames is telling you massive rejection, pick up from the 4-hour or the daily, you want that to tell you higher, massive rejection as well, and you want to ride that pair. Okay, that's the way I do it. So I'm going to zoom out a bit so you guys can see. We had that massive rejection at this point. As you can see, we had the retest. Boom. We had it here. We had here, another retest here. This served as resistance for this level on GBP USD. Came back to serve as support. And again, this is where trend line comes to play. You can see that at the third bounce on this trend line, the market pushed back very strongly, right? And this can also serve as a confluence, a combination of multiple confirmations. We have trend line, we have key level, we have momentum. We have also the 200 period moving average bounce. These are multiple, confluences or multiple confirmations to execute trades. And that's what we want to look out for. That's what determines our entries, right? So now looking at what's going on with pound dollar currently, we're seeing rejection at this key level again, serve that support that we traced all the way back to December. And we have come to make a retest at this previous support that is now serving as resistance. Now, looking at the bigger picture, you'd see that the pound dollar has been moving in what we call a consolidation, right? It has been ranging. It has been ranging. And if you look at the initial trend, you would likely call this a flag pattern, right? But for a flag pattern, it's a continuation pattern, and you want the price to break above and continue in the initial direction, which would in this case be an uptrend. But that didn't happen. We saw the market pull back, took out a lot of stop losses that we had here for people that tried to hop in and trade the range. Because obviously when you see a market like this, what comes into your mind is, oh, I sell at support, but I sell at resistance, buy at support, sell, buy, sell, buy, sell, buy. And what happens? Boom, get taken out. That's why it's important to have multiple confluences and use candlestick confirmations, and also apply proper risk management, right? So we have that break below this consolidation or this range. Now, two things I'm looking out for on the pound dollar, right? The first one is I want to be sure if this is a retest, a break and retest, and the market continues to trade to the downside, tries to make another retest and break below this point, or this is just a fake out and the market is trying to continue to the top side, right? And one of the ways I'm going to confirm that is by waiting for candlestick closes, right? So I'm seeing momentum candlestick here, bearish, but the follow-up was not bearish. So we're seeing a pullback into, and a potential pullback into and above the resistance. This is serving as current resistance for us right now. I'm going to extend it so you guys can see that clearly. We're seeing a potential pullback. We're seeing the market try to pull back and start to trade above this. And I want to be sure. But for me to be sure, I need the candlesticks to close. And that's what I'm going to be observing on the pound dollar. Again, I'm bearish on the US dollar because obviously I've explained to you guys some of the things happening with the US dollar right now. And we're looking at a rejection at significant levels. So I'm bearish for the on the US dollar, except we break the cycle levels I mentioned to you guys, 104.5 all the way to 105. If we break that, give that a sustained break and we continue to trade above that level, then I can start to go long on the US dollar, which means I will be selling pound dollar. But if that doesn't happen and the US dollar trades below that level, 104.5 or 105.0, then I would be looking for potential buy opportunities on pound dollar, right? So if we get, let's say we get the market to break above, let's include this real quickly, to break above this key level, this minor key level we have here. Not really minor because we have multiple retests on it. So if we get a break above it, say like this, so minor pullback, break, and we are trading above this level and trading above the 200 period moving average, then I'll be bracing up for another retest at this key level, right? And I would look for buy opportunities on the pound dollar. Now, I know that you guys can see this horizontal line that I mapped out here, which I think the market is also going to react to on its way to the top, on its way to 1.278 levels. I think the market is also going to react to this point. And the reason is because we saw a lot of reactions in this level in the past, a lot of reactions, and it continued and continued till we had major impact events push the markets down, which obviously broke this consolidation or this multiple action that we had here, right? But on the way to the top, except we have another high impact event that pushed this all the way to the top, I still expect the market to react to this point, right? So this is also going to serve as a point of interest for me, or an observation point, as I like to call it, on the pound dollar. So that's my view on pound dollar. Again, if you guys have any questions, I'm going to use the next 10 to 15 minutes to answer your questions. So if you have any questions concerning the analysis I just made or your own analysis, you can let me know in the chat. So I'm going to be checking the chat to see if you guys have questions. And if you have any, I'll go ahead and answer them. I'm a beginner. Please, how can I calculate pips? So calculation of pips can be a bit tricky for a beginner, but trust me, it's simple, right? It's very simple. I'm going to give you 3 pairs that you can go back and, practice, and I'll just be very brief about it. You can always pause the video. You can come back to this video. It's going to be saved, so you can come back to it. Right. So this is the formula. If you want to calculate a common pair or a typical pair in the Forex market, mostly pairs that are, currency pairs that have USD in them, like GBP USD, Euro USD, you can see that I have 4 numbers after the decimal point, right? If you look at the side, you'll see that we have 5 numbers after the decimal point, but your calculation starts from 4. The last number, you don't want to include that. That's a pipette. You don't calculate that as a pip. This is the formula for 1 pip, which means if you're looking here and we have 1.2700, all you have to do is to add this to get a 1 pip move, which is going to be an increase to this price you have here, and it's going to be 1.27001. 1.2701. That's what you're going to get. That's for 1 pip. For 10 pips, then you have something like this. 10 pip is going to be 0.0010, right? Remember, 1 pip is 0.0001. And when you calculate 2, 3, 4, 5, 6, 7, 8, 9, 10, you take it over, it becomes 1, 0. That's for a typical pair. The pairs that have up to 5 numbers after the decimal point, right? But remember, your calculation starts from 4 numbers after the decimal point. For GBP pairs that JPY pairs rather, pairs that have JPY in them, the formula is a bit different. Okay, I'm going to show you guys in a bit. Let this come up. So for JPY pairs, the formula for calculating 1 pip is 0.01, which means that your calculation comes at the second number after the decimal point. So if we have here 185.300, it means that for every 1 pip move, you're going to get 185.31. 2 pips would be 185.32. It goes for up and down. If it goes down, you subtract. If the market goes up, you add. Okay, but the formula remains the same, 0.01. For 10 pips, that would be 0.10. Okay, so you see it's different. Then for gold, okay, I'm getting your questions, guys. I'm going to try to answer them. So for gold, the formula for calculating 1 pip on gold is 0.1. So for example, if you look here, we have 2043.28. If gold moves 1 pip, you would have 2043.38. You just add this to the price, you get the move if it goes higher. If it goes lower, you want to know how many pips it went lower, you just subtract. The formula remains the same. For 10 pips, you'll be having 1.0. And that's what you want to add to this, right? 1.0. 10 pips move would be 2044.28. 100 pips would be 10.0. So that's just the way. And the higher you go, the higher zeros you add, but you would now start adding to the numbers before the decimal point. So again, you can always watch this video, pause and rewind. It's going to be saved in the Octa YouTube channel so you can understand a lot better. Okay. How do you set up your indicators? You can always add your indicators from the indicator tab. You can just click here and it comes up. You search whatever indicator you want to use, search it up and you type it in. With the Octa web terminal, you can also do the same thing. Sometimes it's indicated by an F sign. You see a curved F sign. You just click on that and you can always use that. Okay, I'll take one last question and we'll just wrap up. And if you have any other questions, you can still ask in the comments and you get your response in the comments as well. Is it advisable to use indicators all the time? Well, it depends. It depends on how well you know how to use the indicator, right? So let's say, for example, you're using the moving average. Clearly, you can see that the moving average kind of smoothens the trend. It shows you if the market is moving in an uptrend, because if the market is trading above the moving average, then you can say, oh, it's moving in an uptrend. If it's trading below the moving average, like you have here, it's trading below the moving average. You can see the 200 period moving average here, trading below. And throughout the time it traded below, it was in a downtrend, right? So it depends on how well you understand the moving average. But for beginner traders, what I'm going to say is don't use a lot of indicators at once. You can practice a lot of indicators, one by one, see which one works with which one. But if you use like 6, 7, 8, 10 indicators on a chart, you may not even see the price action again. You'd be very confused, or you could be very confused. Okay, so don't get me wrong, you can use multiple indicators if you want, but learning all of them at once and using all of them at once may not be ideal for you. So you can learn one by one or two together, try to see how they work and use them. But I think indicators are good tools because I use them, even though I just use the moving average and the RSI and the Fibonacci tool. But I think indicators are good if you know how to use them. So that's the last question, and it's been an amazing, really amazing live trading session with you guys. I'll see you guys in the next